Thanks, Ian. So, just gentlemen, if you feel the need to express yourself with an acronym, we'd like it spelled out what it actually is. That was a request earlier. Now, before we start, we had two of these three gentlemen here for this event last year, and they all gave us a stock, which we'll ask for at the end of this panel. The results were very good, very good. In that period, the All Ords before income was down about 6%. Take into account dividends, probably down a couple of percent. The portfolio of three stocks, and we had Benny, and we had Jeff, and we have Anton, and I'm sure, Crispin, you would have lifted the overall rate if you were there to give your stock. But the overall return was 27.6% once you take into account distributions and dividends. Jeff, you came in an admirable third with your pick of Eclipse at 19.6%. That's hard, isn't it, to come in? I'll say third, I won't say last. Anton picked Steadfast, and it returned 27.8%. And bragging rights and winner, Ben Griffiths, you picked Auckland Airport with 35.5% return. And the quote at the time was, and I might be stealing your thunder here, Benny, is that real money is made in our business in sitting on good quality stories over the duration and not day trading in and out. So I presume from that point of view, Auckland Airport's still in the portfolio, is that right?
Absolutely, Matthew. Prominent in our top 5 or 6 positions, and we'll be staying there.
So congratulations.
More about that later.
Yeah, well done, gentlemen. That's a great return. Okay, so we'll get those stocks off you at the end. So if you haven't thought of one, start thinking now. All right, let's kick off with you, Benny, the winner. You get the first chance. Australian equity market, let's cut to the chase. What sectors look good at the moment? What is really taking your interest in this environment?
Sure, the one sector that we think looks good and has looked good for a while, and I guess the selection of Auckland International Airport is a great lead-in. The sector that I'd nominate is the New Zealand sector, the listed New Zealand space, which this time last year was about 6% of our portfolio. Today it's close to 16%. There's a whole lot of things going right in New Zealand. I guess all of us in the room will be aware of the tourism boom that's being enjoyed, the net immigration that's occurring there. There's a construction boom that extends just beyond the rebuilding of Christchurch and includes a full-blown boom in Auckland. And so essentially we've positioned ourselves nicely in Fletcher Building. Trade Me is our biggest position in the portfolio. Auckland we've talked about. And EBOS is another holding. So three of our top 5 positions are New Zealand based. There's a lot going on. I've even seen, I guess, a few things mentioned about New Zealand being the Silicon Valley of the Western Pacific. And
that's how I've always seen it.
That's how you've always seen it. That's how it's emerging, and we go over there 3 or 4 times a year now. It's been such a fertile hunting ground. So New Zealand, I think, is a prominent sector in our portfolio. We think that continues.
Okay, we'll give you the same question, Crispin. What sector or sectors, you might give us a couple, that stand out from the rest at the moment on the long side?
Okay, well, I'm going to give you none.
Okay.
Now, but what we see is a market where stock and sector volatility is going to be, a lot higher than the overall market volatility, and that's because we're in a world where growth is very low and most sectors are facing some level of disruption. And that disruption can come from technology change, it can come from global business models like Netflix entering, it can come from globalisation like we're seeing in the steel industry, or it can come from regulation. So in every sector, in every industry, there is unprecedented amount of change that is occurring. And so there's and that's in a context where growth is low. So historically, when you picked a sector, it was because there was some great industry structure that was giving you improving returns, or the cycle was helping improve returns for that overall sector. Today, what you're looking at is companies' ability to respond to change. And secondly, you're looking at how the market is pricing certain stocks and their ability to respond to change. And the market moves from being in denial about change to being in despair. And so what we are looking for is in each sector, the company which has sort of been either discounted the most or has got the most appropriate response. So if you take the banking sector at the moment, and I saw the discussion before, we think there's still some areas of the banking sector that are challenged, but we look at an ANZ and see a company that is acknowledging the mistakes it's made in the past, making some changes, and is being heavily discounted still by the market. So from our point of view, it's the case-by-case opportunity that really stands out right now.
Okay, Jeff, you've actually got the job with your new fund to find sectors you like at the moment. Can you give us a couple, one that stands out?
Is that my job?
No, but we're happy to hear what you think.
No, that's Chris Stott's job as the Chief Investment Officer. No, I'm just a fellow portfolio manager with him. Okay. But in terms of sectors we do like at the moment, and in our, besides the Leaders Fund, one that we've got a fairly high weighting in, I think for us it's 6 or 7%, which that is high, is the fleet management sector. It's SG Fleet and Smart Group, which have perform well over time, but we also think over the next period will be good performers, particularly as we've seen the concern about changes to FBT from both sides of politics have been ruled out in terms of before this election. And the other sector, if you call it a sector, is I know it was discussed earlier, but our view on the Australian dollar is lower, potentially significantly lower. And it's looking for companies that will benefit from that. And two we have in the portfolio that we like, Treasury Group and also Ardent Leisure.
Mm-hmm. Okay.
So if you had to, they're the two.
They're the picks. Okay. So let's stick with the good side, Benny, rather before we get to the negative side, because we had a lot of negative comments in the last two panels. So what if we came back in 5 years' time, if you got some ideas about what the leaders in this market, whether it be the small end of the market that are going to grow through, whether it's in the big end of the market that will thrive in the next, that medium period. Have you got a few a few names, a few sectors that will do well over that period?
No, sure. I mean, look, I think the Small Ordinaries itself has been a strong performer through this year. I think all the rudiments are in place for the Small Ordinaries as a complex to continue to, in its own way, lead the market. It's been outperforming strongly versus the ASX 100. Those stocks are set to continue and extend that outperformance, is my strong opinion. I believe the quality of our benchmark, the constituent members, the names of the stocks that are in there, the companies that are in there, is as good as at any time I've seen that benchmark in 15 years of looking at this space. So we've got quality names there, and I think our sector will continue to push upwards and advance quite strongly. The Small Ordinaries Index as a group. There's two stocks that I would highlight. One we own and one we don't own. The one we own I'll talk to at some length. PWR Holdings, or PWH is the ASX code, and it's a specialist automotive manufacturer of engine cooling, intercoolers and oil coolers, based in Brisbane. It's a genuine example of an Aussie export story. No debt on balance sheet. We'll enjoy, to Jeff's point, we'll enjoy the downdraft of the Australian dollar. This particular company supply those devices, air coolants and radiators, to the motorsport industry primarily. Formula One, NASCAR, the rally segment, V8 supercars. And the upside comes from this story, not only doing such a great job there, but being able to service or supply that product to adjacent industries, conventional, commercial, automotive applications, military and trucks. So that's one stock I think will perform well. It's a future leader of our space, and I think will be prominent, will pay substantial and impressive dividends. And the other one's Baby Bunting, which listed just recently, and that's an impressive retailer, again another specialist of baby software and hardware, and that sort of business, given it's so infant, no pun intended, in terms of its rollout from 35 stores now through to 70, with substantial logistics and inventory management gains to be booked. I think that stock also performs very strongly going forward. It's that sort of business that investors in our neck of the woods, that is in the Small Ordinaries, should be busying themselves looking at. So there's two names of two stocks that I think will be prominent in our space: PWR Holdings and Baby Bunting.
Okay, Chris, let's go to the big end of the town where that drives the index going higher with the same kind of time frame. But before we came up, we had a bit of a chat about everyone was so bearish in overall. That was the theme. But there's a wall of money out there. There's retailers, there's managers. Everyone's sitting on a lot of cash, which is not giving us much return. Under that scenario, what can drive the market higher, and what areas of the market can we get a re-rating here? And so if we're sitting here in 5 years' time, traditionally the stock market's up, unlike it has been over the last 10 years. How do we get back to those kind of growth levels? and what drives it?
Yeah, our view is that the overall return for Australian equities is going to be probably mid-single digits. So we don't expect material upside. And I know it'd be a lot easier for me to say there's a lot of upside there. But we're in a low return world. When bond yields are down at 2% and cash, is now below 2%, and all the other asset classes have re-rated over the last few years, and that's what the last panel was discussing about. So you've had these supercharged returns as everything's re-rated, reflecting a low discount rate. But we're now adjusted to this lower return world. And so I think, return to mid-single digits is probably the most likely outcome. And when you've already got a yield of 4% plus, the actual index itself is only going to creep higher very marginally over the next few years. Now, it may not sound exciting, but relative to most other asset classes, that's actually a lot better. And then on top of that, I think, if you've got the sort of information advantage that you can get by accessing companies all the time, I think you can add to those returns. And so you can start achieving high single digit, almost double digit returns. So that to me is the challenge for investors now is realising that's the world we're in. So when you look at our market, you can break it down. And I come back to this issue, which is it's going to be case by case. The idea of being able to set and forget your portfolio and just own a sector that's going to outperform for the next 4 or 5 years, I think that's very challenged because things are changing so quickly. When you look at how quickly Audi impacted Woolworths, where margins halved in the space of a year. What's NBN going to do to Telstra? That's a huge issue that's going to come through in the next couple of years. So there are definitely some challenges that face the market, but equally you've got a lot of companies, and I'll give you one example, which is Metcash. The great thing about equities is that they've got the ability to respond to what's happening. So if the current management team isn't doing the job, then they'll get replaced by shareholders and someone else will come in and try and do something. So it's a dynamic situation, which is unlike a lot of other asset classes. So with Metcash, which is the most affected by the entry of Audi, the share price collapsed from over $4 to $1 around September last year. And at that point in time, people had thrown in the towel on that company and was valuing the supermarket business with negative value. But at the same time, you'd had a new chairman, you'd had a new CEO, a new head of supermarkets, a new chief financial officer, and they were making hard decisions. They sold a business, fixed up the balance sheet, they cut the dividend, which was unpopular, but the right thing to do. They looked at their CapEx and realised that they had to pull back on CapEx and be smarter about capital allocation, and they took some costs out. And that business went from being negative value to actually being ascribed some value, and in that time frame, the stock's basically doubled. So these opportunities are there because the market gets too emotional in the short term around bad news. And that, unfortunately, is the environment we're in. You've got to be case by case, stock specific. That's where the opportunities are. There's no ETFs that are going to cover you off on that. You've got to be in there looking at individual companies.
Okay, Jeff, I'll let you be a bear for a couple of minutes.
I think it's fantastic.
Being a bear?
No, just just what everyone's saying, because I was here for the earlier panels, and the first panel, geez, I thought, well, I'll sell my house. Well, at least we've got some population growth in Australia. Phew, don't have to sell the house. We're going from when the lady dies on my street, there's going to be no one to buy the house. I thought I better get out. But at least everyone was so bearish. At least the equity guys, we're sort of brought a bit of life back into the discussion.
Well, let's turn it the other way for a sec.
You want me to be bearish?
Yeah, a little bit.
I am bearish, but
yeah, you're always. And the quote in Jeff's book is "Buy when there's blood on the streets."
Yeah.
I prefer your other one, which I quoted, was "You can't kiss all the pretty girls," which
but
is
you can try. You can try.
Which is a lot more forgiving. But how does the index head south from here? How does it underperform? What would take the market down, do you think?
Well, I suppose you just got to look at where we are in perspective. Obviously, the US market, the biggest economy in the world, the driver of global market. So you look at the performance of the US market, and it's now the US market. It's the second longest bull market ever. The longest bull market was 87 to 2000. I think it was 4,494 days. And I mean, the tough thing about that period is we had a crash at one end and we had a tech wreck at the other, in terms of wedging that performance. So we're now in the second longest bull market ever in the US, and I think it's the fourth longest economic cycle, since the 1840s or something like that. So all that tells me is things are mature. I don't know how mature they are, but we are in a mature stage of a a bull market. And then we look back in Australia, and I know technically we're in a bear market, but if the US market does falter, then obviously it'll have a sizable impact in Australia. In terms of one of the good things is everyone tends to be negative. In terms of, it's very hard to find value. At the moment in our largest fund, WAM Capital, we're about 32% cash, but that's not necessarily overly high for us because over sort of 18 years we've averaged about 34% cash. But in terms of looking at the next 6 months in Australia, I think it's going to be a tough 6 months. The economy seemed to have slowed down when they call the election, which it always does. It's been a long election period. We'll probably have some further earnings downgrades over the next month or so.
Tough in the short
it's going to be tough.
Yep. So, Benny, every market's got complacency. We saw it a year or so ago in the oil market where everyone said, well, $100 is good for everyone. Good for the producers, good for the purchasers. And before we knew it, it was down at $27. Complacency set in.
Sure.
Is there any areas in the market that you see now that we are suffering from complacency? And last year you gave us a little bit of lead in, which hasn't happened yet, but you were worried about the property trust, which you quoted as a poor man's bond.
Yeah.
And I presume you're sticking by that. So complacency, is it around property? Where do you see those pockets of complacency and how do they play out?
Yeah, well, I would identify again, speaking with a small cap perspective, the one strongly performing part of our little market that I guess for 2.5 years now has performed exceptionally strongly and we've all milked great returns, and I think complacency is set in there is the aged care sector. Matthew, where there's 3 listed players, there's Estia, Regis and Japara, to name 3. They've only been around in a listed state for about 2 to 2.5 years. We had prominent and quite aggressive positions in those. Today we have no holdings in those. And there's a couple of things happening there where I think the market will be shaken from its complacency. Not a deep slumber, but certainly some complacency is set in. The first thing is, to Jeff's point on the federal government revisiting budgets and fiscal attitude, at the end of the day, the federal government spends $11 to $12 billion a year on aged care accommodation. They fund 80% of the cost of a bed. We think that the federal government is potentially going to cap that or reduce that level of spend. That's not great news for aged care operators. We think the level of bonding, which has driven the sector, and essentially you sell your home, you take a good chunk of the proceeds and pledge it as a bond for a bed in an aged care facility. That's been somewhat in boom conditions, and that has fueled the growth of that sector. We think that the 2-year cycle of that, because the average resident stays 2 to 2.5 years, the average resident is actually pretty close to being at the point where they're going to be leaving. So bonds coming in now are being used to essentially pay people leaving, rather than before that, in the last 2 years, you've seen essentially bonds funding brownfield and greenfield development. I'd also talk about balance sheets on these businesses. 2 of the 3 companies that I mentioned before, in fact, the whole sector came to market net cash, so the balance sheets look robust and vital. Today, 2 of the 3 actually have quite extended balance sheets, and net debt to EBITDA, which is a measure of gearing or leverage that we apply, is around 2 times, which is, it's a little too high for our liking. Mm-hmm. The median house price, we heard some discussion on property prices. If you think property prices have peaked across Australia, then it's important for people coming into these aged care centres to sell their home and then pledge their bond. If property prices are coming down, their ability to fund the bonds is somewhat impaired. Okay. And the final point I'll make, just to drive home the complacency side of thing, is that there's been a lot of corporate activity, a lot of acquisitions of aged care centres by these listed vehicles, and it's in part propelled those share prices higher. I think the prices of some of these aged care properties have become prohibitive, very, very expensive, and it means that every transaction, or a lot of transactions that these companies are planning on making, they may not get that earnings per share accretion. They may not actually be able to grow earnings at the prices they're paying. Okay. So we think there's one sector which the market has fallen in love with, and we've fallen out of love with and have done something about it.
Good. So, Chris, there's a number of defensives that seem really expensive on a PE on a normal basis. Obviously, we go to infrastructure, which has been a great leader, and some healthcare stocks, and they've been seen as defensive, reliable earnings. You can keep on keeping on. Can you give us a view? Do you think there's complacency around those couple of big sectors that have helped drive the market higher?
Yeah, look, it's interesting when you look at the structure of the Australian market. A lot's made about the proportion of banks, a lot's made about the proportion of resources, but the bond, what I call the bond-sensitive part of the market, which is excluding the banks, that's now over 20% of the market, and that's doubled over the last few years. So this is now bigger than the resource sector and catching up with the bank sector, and it reflects exactly what you're saying, Matthew, which is that there's a lot of people who, they're referred to by others as bond refugees. They're people who've been forced out of low-yielding assets and looking for a home, and all they want is something that they can rest at night with. And so, and then to the point I think Paul Moore was making earlier, which is you get price action. These stocks keep growing up, their volatility is incredibly low. So the very attributes that people are looking for are getting reinforced because more and more people are chasing those assets. So I think there is definitely some elements of risks in a lot of those defensive names. The challenge is what is the catalyst for that unwinding? And that catalyst may not occur for a little while because interest rates look like they're coming down further. Bond yields have just fallen a bit further. And so, all of the factors that have driven people into those assets are still there. But that does not mean you necessarily want to go and chase them, And if you own them, well done, but you'd be looking at points of exit.
Jeff, you've been around in markets, I'm just trying to guess, a long time. And
it's interesting. I did notice that Benny put plus on his, like how many years plus? Was it?
Plus.
And I put plus on mine. I don't know. There was only one other, 25 years plus, 35 years plus.
So you got him.
I don't know what the plus is.
You got him covered by decades. So Benny might know how to answer this question, but you might. Resources go in long cycles, and we've had a bust effectively from a big boom. Do we have any short-term hope there, or do we see, it's a supply and demand issue, and they take a long time to unwind, and the resources are put to bed for a number of years?
I think on that's the scenario. That is a long cycle, and we're only a few years from the top of the previous cycle, and in terms of the what are we doing? There's the great thing about busts is there are always opportunities, and if you look at the small resources, you can get some small resource companies that are trading at discounts to cash. Now, obviously, you've got to make sure what are they going to do with the cash they've got there, how they'll invest it. But how we're playing it is we're looking at some of the companies, the mining services companies, and there's a couple that we've bought in the portfolio. Southern Cross Electrical, I think if you take the cash out, we're paying a 4 or 5 times multiple, and the other one we bought in the portfolio is Macca, a little slightly more expensive, but again, we think the worst is over with some of those mining services plays, particularly the ones that have significant levels of cash, so the opportunity for them to go under.
So it's more cherry-picking balance sheets as opposed to
it's
believing in a cycle rebounding.
100%, and where you always make the money is in the whether it was go back up to the 87 crash. The amount of wealth that was made in the companies, like the Wesco, the media companies that had enormous amount of debt but survived. So you get enormous leverage on the equity, and that was the Wescos, or in those days the Prime TVs. Those media, or after the tech wreck, the likes of the Melbourne ITs or the Reckon, where you're buying their business at a discount to cash. I mean, we tried to do that in the after the GFC when we bought shares in Everest, Babcock and Brown. The fund manager thought, oh well, look, we're buying at a discount to cash. If the business is worth something, then we're going to make a multiple on our money. The unfortunate thing is the business wasn't worth anything. So we made a little bit of money, but that was just coming back to cash. So to me, it's a good time because everyone's turned off that sector to find opportunities. Benny looks as though he's got a couple of stocks.
No, I do. I'm grabbing Matthew's arm. I want to say something. It's not often that I would concur with Jeff on a matter pertaining to stocks. And what I do want to say is that our team have just come back from a visit to WA, and I'm not for 1 second advocating it's time to pile back into mining service companies. I'm not, but I'm suggesting that the folder stay open. And we came back with some reasonable encouragement, I must say. We were last owners of mining service stocks back in mid-2012. And we came back, and what we observed from the number of the companies we met was very reassuring. And I, like Jeff, are not calling for the next commodity boom. It's been 8 years since commodity markets actually sold off properly and bottomed as a collection. But I think what we have seen are mining service companies resetting their businesses, whether it's purging management teams, whether it's reducing operating expenses of the businesses, getting balance sheets right, divesting businesses that don't work any longer. It's business, so resetting businesses. It's also diversification that mining service companies have been engaged in as well, moving from the west coast to the east coast and getting involved in infrastructure works. It's commodity markets not so much coming alive, but the Australian dollar falling and breathing life back into a number of Australian mining operations. And the final point I make, which is important for everyone in this room, is that the Australian equities market is back open. It's back open for business. The function of being able to raise fresh equity is actually happening right now. Today, Sundance Energy raised, looks like they've got away with raising $80 million. 2 to 3 months ago, that was unthinkable. We've seen a number of lithium companies, promising lithium startup businesses, and more than startups, they're about to push the production button in some cases, have raised hundreds of millions of dollars to promote new business projects. The point is, it's with us.
I'm going to ask you at the end about the overall market. So we'll
Sorry,
get to that. No, that's all right.
I just had to, when Jeff lines up with me,
It
doesn't happen often.
We can, Chris, because we've got to do about 10 minutes of questions.
Yeah, just very quickly on the resource sector. I mean, people talk about the long cycle, but resource as a percentage of the overall market peaked at 40% about 2 or 3 years ago. That's now 15%. So the markets are very efficient in terms of pricing the future. So I think a lot of that long cycle is in the price of resources. But the outlook for resources comes down to one key call. If you believe that China is sort of going to muddle along and steel output is sort of broadly flat from here, then there's some opportunities in the resource sector. I think overall it's probably not a standout, but some opportunities. If you believe that China has got another leg down because the issue of bad debts is going to materialise and start hitting a lot of these heavy industries, then we'll get another wave of problems in the whole resource sector. So that's the key call you've got to make.
Okay, so questions. Has anyone got a question? We're going to do about 10 minutes, then we're going to get the stock tips and maybe a market forecast. Anyone question? I can kick off.
Hey, how did we go on our market forecasts?
Well, I don't think we did it last year. This is a new.
I was bearish. I think I won.
Okay, we'll go to the tape and find that out and come back, hopefully. There's a gentleman in the middle here that put your hand up again. Oh, lady, sorry. Thought it was you go ahead.
Question for Crispin. You talked about disruption in markets, and I wanted to see what you thought about the alternative energy generation technologies and storage technologies that are coming into play, and whether that has been factored into the price of our big cap, Woodside, Origin, or whether there's another leg down. So, the alternative energy that everyone's talking about, solar or whatever, electric cars.
Yeah, so I think that there's 2 aspects to that discussion. So the first one is directly, storage. If you can resolve the issues around being able to store for longer periods of time, that massively transforms the power generation industry, because suddenly, the ability to, use solar and wind and be able to then regulate that for when people need that power, and that's part of the problem at the moment, is it's windy, not the right time for when people want to watch, My Kitchen Rules and so forth. So storage would radically transform that, and there's very polarised views on how quickly storage solutions can come through. So that is a huge area of contention and debate. But if storage does sort of materialise as a major factor, then you've got a whole set of issues about assets which are no longer going to have any real value. And a lot of the power capacity in Australia would be potentially at risk at that point. So that is a big call. I think sometimes these things do take a little bit longer than maybe the sort of the advocates for change would suggest. The other aspect to it is, what does it do for oil demand? And this is a global issue. And so when people think about the oil market at the moment, it's very easy to see supply slowly coming down, and that will continue because CapEx has fallen so much in the industry, and you have natural decline curves in terms of oil production. But the assumption that a lot of people have is that underlying oil demand will still be 1 or 2% positive. If you start seeing the real rise of electric vehicles and the substitution of transport fuels with other aspects like LNG, then again, you might find that demand for oil globally disappoints, and that will clearly have a significant effect on the oil price. So they're very big issues. You're absolutely right to highlight them.
Other questions? The gentleman up the back. We'll come to you next. Just there. Whoops, she went past him. There he is.
I've only got one mouth. I don't need to. My question's to Crispin. In fact, I can't reconcile something that you've said. You've said something similar to a benefit of equities is that directors can be replaced by shareholders. Now, I'd like some evidence where this has ever happened of recent. I take the reverse position. I get awfully frustrated by the fact that there isn't accountability for directors. I take this position because fund managers, super funds and large holders of shares are mute and silent about the whole lot. There are many examples whereby directors should be held accountable. I just don't know. I can't recollect one case where they have. At the moment, we can look at firms like Woolworths, we could look at banks with their bad behaviour and lack of ethics. There's many areas, so how can you reconcile that statement? I get frustrated by the reverse, that we do not get accountability of these people, and some of them are not dropped.
Sure. I mean, I share your frustration in a number of situations. So I was specifically referring to executives rather than directors. So there's a lot more turnover at the executive level than there is at the director level, and I think you raise an interesting point that there should be more debate and changes at some level, in a number of companies at the director level as well. But if you go through some of the examples that you've just touched on, it has been a management change at Woolworths. So now you can debate whether that's going to resolve the issue, but there has been management change there. I gave the example of Metcash. ANZ, I think there's a material management change at ANZ that's led to a significant shift in the strategy of ANZ as they de-weight from Asia. So I think there are examples where if companies aren't responding to situations that, the executives often too slow the process, but they do get changed. And sometimes the pressure and the threat of change is enough to engender some change of strategy. But the key here is that a lot of companies aren't doing this, and those are the companies you've got to avoid investing in, and you've got to focus on the companies where you are seeing action being taken.
Gentlemen.
And I mean, on that, I'd be interested to know, because Benny and I, we tend to play around in the mids and smalls, and I know from our perspective is if a company we don't think is doing the right thing and we own more than 5%, then we're very happy to. We prefer not to, because it's costly and it costs money and time and effort to call an EGM to change the board. And probably the largest one, it wasn't very large, was RHG a number of years ago. But I'd be interested I assume at the big end of in terms of the the BTs and the guys that are dealing with 20 and 30 and $40 billion, that you as an investor, you don't see the pressure they're putting on the boards in terms of the larger fund managers are trying to get change, but Probably they're doing it a little bit more
Subtly. And
subtly
without
than
blood.
maybe we do. Yeah.
Well, I think it's whether you do it in public. I mean,
Yeah.
so that's the big issue. I mean, you can have a very intense and robust discussion inside a room, and we believe that that is a better mechanism than trying to go out and use the media to create pressure, because in many cases these large companies will not respond well to that sort of media pressure. Now, sometimes you do need it to reach the media to engender change, but certainly do not read it that we're sitting there passively and other fund managers sitting there passively. There's some pretty robust discussions, and it really comes down to those companies where there's been poor allocation of capital over the years. And we all know who those companies are, and you can rest assured that there's been some pretty sharp conversations.
I just add to both Jeff and Crispin's comments that the AGM season, the annual general meeting season, consumes an enormous amount of time of each fund manager. There was a time we had the full year and the interim results, and that's where we really had to bunker down and do a ton of work. The AGM season now, sir, can I just tell you, consumes almost as much time as we pore over the proposed resolutions. We consult the proxy advisory services that almost all of us subscribe to, and we are accountable for how we're voting. If we want to rock the boat, we need to explain why, or if we want to not object to something that's contentious, we also need to explain why. So it's probably a little unfair to say that fund managers sit back mute. We do anything but these days. A decade ago, I would concur. Fund managers were a fairly somnolent bunch when it came to this, came to corporate governance. But today, we are all very, very active, trust me.
And you just mightn't see it.
Yeah, absolutely.
Yeah, it's behind.
And to take the battle public, to Crispin's point, is time-consuming, exhausting, and it's often more effective just to tackle it behind the scenes.
All right, we've got time for one more question. Gentleman here in the third row.
Just going back to Benny's comments on lithium, you mentioned a few lithium companies. I'm just interested to get your thoughts on the thematic there.
Yeah, obviously a hot spot at the moment. I guess a sign of a healthy.
What's your lithium pick, Ben?
We've got a couple, Jeff.
Just give us one.
Just wait. You might put it on your shopping list. You've got 400 million to spend, I hear.
Yeah. Oh, I got to beat you. I got to beat you this year. That's yours.
That's what I read in the paper. Lithium, clearly, I'm no expert in lithium, but one thing for sure is lithium is being redefined in terms of battery and power storage. To that lady's question before about energy storage, lithium is coming to its own there, or is about to come into its own. Like every interesting boom, you get a speculative blow-off, and that's what we've had in a number of these lithium names. There are companies now being recycled and coming back out as new lithium miners or juniors or explorers. That's all underway. I think that's a healthy sign. I think it feels to us very much like the underlying or undergirding fundamentals for lithium are improving in terms of demand. It's quite a complex manufacturing process or production process. We're getting our mind around that. We own stakes in 2 small lithium plays. We've got some Galaxy resources and we've got some mineral resources. 2 fairly careful way to play that space, ones that are either at or about to start production, where we're reasonably satisfied. In fact, we are satisfied with the project economics, and we've got we've placed a small position there. But lithium obviously has captured the market's imagination. Hundreds of millions of dollars have been raised quite efficiently in probably the last 12 to 18 months. Lithium, it's early days, but if you believe the electric car, you believe the Chinese claims they want 5 million electric cars on the road by 2020. We've all seen the prognostications from Tesla and what they're planning. There seems, unlike many other commodity booms, which we saw rare earths where much excitement comes to nothing, it does feel like there's a genuine demand driver, and that is supporting the market's newfound enthusiasm for lithium. So we're keeping an open mind. We've got 2 very small investments in the space. We're learning every day. Deutsche Bank today have held for the 3rd year in a row, have held a lithium conference. I mean, unthinkable 5 or 6 years ago, a lithium conference. They had 60 delegates there today. So there's a learning process that's going on. I think lithium is an interesting spot. Industrial minerals have got a checkered history in terms of their performance in a stock market sense, and I think we'll be we'll be monitoring it. We'll be keeping close to it and obviously looking to learn more about the space.
All right, time's our enemy.
And-
We've got to.
Are they having a tulip conference as well?
Yeah, we got one next door.
Sorry.
Stock and index. Let's go with your stock tip for the next year, given you're the reigning champ.
Sure. I've tipped. I think it's in your packs there.
4 o'clock? Is the market closed? I see a couple of people up near the back door. I noticed.
It's well past 4. Well past 4.
I've picked Aventus Property Fund, which is Brett Blundy's third business he's brought to market. It's essentially a portfolio of 15, soon to become 20 homemaker centres. These are scattered through the southeast corner of Australia. There's the land holdings that these particular homemaker centres on are is clearly extremely valuable. The company is trading on a premium to NTA, which happens from time to time, as I've found with the good property trusts. They all trade at premiums. When I wrote the note that's in your packs, it was about a 10-12% premium to NTA. That premium has since gone out. Word seems to have got out that perhaps Aventus was going to be mentioned. But Aventus Property Fund for us is a very, very attractive homemaker centre REIT with ample growth ahead of it, looking to yield probably circa 7% on FY17 numbers.
Now, can you give us the index percentage change? Probably the easiest over the next year.
My levels on the ASX 200, the levels will be 5,700 in the short term, pushing through to 6,000, potentially March quarter next year. I remain reasonably bullish. I think the case for equities is positive, notwithstanding some comments that, or some of the discussion points from the panel. And last time we caught up, Matthew, the call was longer term call on the market before Jeff tries to claim it. And my view was that our benchmark, the ASX 200, would work its way towards 6,800, which is the old high. Now that's a medium-term objective for me.
Okay.
But 5,700 in the interim, going to 6,000 by March quarter.
All right, that's bullish. Crispin, we're going over, so you're just going to have to give us a name and a percentage change. That's all. Benny's given all the explanation.
Right, well, the name is going to be controversial. That's Qantas. Okay.
On the up or down side?
On the upside.
Yep, and
And the fact that you asked me that is part of the reason that we like
good.
it.
And the index, how much does it change in which direction over the year?
I think the index will be up 2% from here.
Up to Jeff, thank you.
Well, I'm indexed down 5%. And I mean, it's APN that's in the, it's getting out of old media, coming to new media and re-rating because of that. But now I've got to, because Benny won last time, I've got to throw a little smoky in there. Because I probably need 2 horses to beat Benny. So I'll put class. Now, CL1, we try to buy stocks on low PEs and sell them on high PEs. This is on a high PE. You can do your research
now,
what it is, but on a PE of 40, growing at 50% per annum. Right. Interesting story.
Very good, thank you. And we've got the.
Oh, do you want another one?
No,
we're on 2 against 2.
No,
Gets 2 picks.
No, he doesn't. He goes with the first one. Okay. So I'd like to thank Jeff, Crispin and Ben Griffiths for joining us, and we give them a round of applause. Thanks, Shane.